Good morning, good afternoon, and good evening, everyone. Thank you very much for joining us as we launch the 2026 Global AI in Financial Services report in collaboration with the CDIR, the Cambridge Digital Innovation and Regulation Initiative. My name is Brian Zhang. I am the Executive Director of the Cambridge Center for Alternative Finance and the Executive Chair of Financial Innovation for Impact. As we know, AI is transforming many sectors, including finance, reshaping the provision of digital financial services, reconfiguring institutional operations and market architecture, and giving rise to new intermediaries, interdependencies, innovations, risks, as well as policy and regulatory implications. To navigate this fast evolving and increasingly complex landscape, we need more timely, empirical, and global evidence to inform decision making. Over the last 12 months, the CCAF and FI, working in partnership with the Bank for International Settlements, the International Monetary Fund, the World Economic Forum, the IDB, CCAF, and the AMF, and with the support of the World Bank and the UK Foreign, Commonwealth, and the Development Office, as well as many ecosystem partners, co-produced this 2026 Global AI in Financial Services report. We hope this report can help advance our collective understanding of the adoption and impact of AI in financial services, bringing together perspectives from a unique intersection of financial services providers, AI vendors, and regulators. We wish to thank all the partners, supporters, 628 survey responding institutions, and our combined interdisciplinary research team for their hard work and dedication. We'll begin today's launch event with a presentation of key findings by our lead researcher, Kieran Garvey, and we will proceed with a high-level panel discussion in collaboration with the CDIR as part of its virtual policy forum series. We'll end the webinar with the publication of the report. Now, without further ado, I pass the virtual mic to Kieran. Thank you.
Thank you very much, Brian, and good afternoon, everyone. Really pleased to be able to present the findings of this landmark study with you. I'm incredibly grateful to the team and the partners that have helped to make this happen. Between last October and this January, we deployed 3 global surveys for regulators, for industry, and for AI vendors. And we captured insights from 628 institutions from 124 countries. This included 352 financial institutions, 148 AI vendors, and 130 regulators. And we've distilled this down into one global report that we'll be sharing at the end of this event. Very excited to share this with you. So let's jump into the findings around the state of AI adoption. We found that 81% of surveyed financial institutions are adopting AI at some level. However, there is a profound execution gap between regulators and the financial industry, and the contrast is stark. 40% of industry respondents report advanced AI adoption, meaning they're scaling or transforming their operations with AI. And this is double the 20% reported by regulators. Furthermore, 48% of regulators report that they're still in the earliest stages of AI adoption or are not engaged at all, compared to only 19% in industry. Now let's have a look at the specific technologies driving this AI transformation. So classical machine learning has become well established in finance over the decades, and it remains widely adopted, with around 3/4 of industry adopting ML to some degree. However, Gen AI, which only gained traction in late 2022 with the launch of ChatGPT, has already reached around 70% of industry adoption, effectively reaching parity with long-standing ML methods in a short space of time. This incredible velocity reflects lower engineering barriers to entry for Gen AI compared to traditional ML pipelines. But the true frontier we are all watching is agentic AI. And our research shows that 52% of industry are already actively adopting agentic AI at some level, 23 in advanced stages of adoption, and 29% piloting. For regulators, only 28% report piloting or deploying agentic AI. And this major gap points to a potential emergent supervisory risk, an increasingly autonomous financial industry that is outpacing regulatory adoption of agentic oversight tools. Okay, so where is all of this technology being applied in industry? So currently, development and deployment is heavily concentrated in internal operations rather than business model transformation. Four of the top five financial service applications are back office functions. The most mature use case globally in industry is software engineering, with 42% of firms fully deployed and another 33% in development. And this progress within software engineering is being driven by firms such as Anthropic with Claude Code, which are revolutionizing the software development lifecycle, rapidly introducing agentic capabilities. Other mature applications include AI for data visualization, process automation, data and knowledge management. And for risk and compliance functions, fraud detection is well established. In the front office, AI-powered customer support is a key growth area. But are these applications delivering real value? The answer is nuanced. 69% of industry report feeling a positive impact on productivity from AI. However, translating this into measurable enterprise value is challenging for stakeholders. 55% of industry, 63% of regulators find it challenging to measure the value of their AI deployments. And when it comes to the bottom line, 40% of industry report increased profitability from AI and 43% report no change. So which types of firms are seeing increases in profitability? Firms that report higher AI adoption maturity also tend to report increases in profitability. Furthermore, higher investment seems to correlate with higher financial returns. 61% of firms spending more than $100,000 annually on AI also noted increases in profitability from AI. Turning now to foundation models and cloud infrastructure. So underpinning all the use cases we've just looked at is a highly concentrated, rapidly evolving AI infrastructure market. And most organizations are not training AI models from scratch themselves. They rely on a handful of major technology vendors. At the time of this survey, OpenAI was the most used foundation model provider, utilized by 69% of all respondents. But as you all know, this is a rapidly evolving space. More than 83% of respondents rely on one of five foundation model providers. And when we look at cloud infrastructure, Amazon's AWS leads the industry at 41% of total respondents using their services. And over 2/3 of respondents use one of three cloud providers for their AI workflows. So what is holding the sector back from full transformation with AI? The same challenges that have faced the sector for many years: data, talent, legacy technology estates. For AI vendors, the number one challenge they face when working with their clients around AI is data quality and availability. For regulators, the primary roadblock is lack of AI training and capacity building, and the struggle to retain and attract specialized talent. And for industry, they also echo the talent constraint as well as data quality. So this brings us to the critical topic of risk. We asked participants to rate their top five concerns about AI in finance, and we surveyed across 22 different risks. And what was maybe surprising is that there is broad consensus across all stakeholders on the leading threats. Number one, data privacy and protection. And number two, followed closely by concerns over model hallucinations and unreliable outputs. Now, despite these convergences, we did observe some interesting divergences. So regulators and industry are deeply concerned about cyber and operational resilience and adversarial AI. Vendors appear to be prioritizing other risk areas. On the other side, industry and AI vendors place more emphasis on the loss of human oversight compared to regulators. And as AI systems are becoming more automated, organizations may be losing their institutional memory and capabilities to execute processes manually. And this is a cause for concern, especially when crises emerge. So let's have a look at the issues around explainability, where there's a clear expectation gap. So 79% of regulators rate model explainability as critical or important to achieving their regulatory objectives. However, only 50% of industry have actually adopted explainable AI methods to any extent. And vendors report that more than half of their clients in the financial services sector have low or no expertise in using explainability methods. I think this highlights really the sheer complexity of AI explainability, which requires substantial technical expertise. And there are also challenges around whether current explainability methods can even be applied to the most complex AI systems. And this is a challenging area, and we dive into this in the report. An important question to ask is when harm occurs as a result of AI in finance, who is responsible? And regulators tend to maintain a traditional stance. 38% stated that primary responsibility must remain with the regulated financial institution. However, more in industry and vendors recognize that shared accountability frameworks may be appropriate or see the need for case-by-case approaches. And given the complexity and dependence that so many firms have on the AI supply chain and increasingly autonomous processes, this is definitely an area that requires further investigation and clarification. Now, looking at the impact of AI on jobs, the picture for 2030 looks very uncertain. 25% of industry expects significant reskilling. 24% expect a net reduction in roles. 23% say it is too early to tell, and only 10% anticipate a net increase in roles. A very mixed view indeed. But despite these challenges, regulators are optimistic about the potential of AI. The vast majority believe that the use of AI can help them to achieve their regulatory objectives. Generally, the view of AI is viewed positively, while also recognizing, obviously, particularly challenging areas, for example, within cyber, fraud, AML. So let's have a look at how AI is being used within regulators, which remains largely exploratory. So despite these relatively low levels of adoption that we see today, there is a tremendous amount of active interest and momentum building within regulatory bodies to harness AI tools. And the dominant, most advanced use cases today are around market surveillance, misconduct detection, as well as AML and CFT supervision. I'd like to highlight a particularly interesting dissonance that we found from our research around AGI. So we asked respondents if general intelligence, which is where AI reaches human parity across all tasks, was a priority risk today. And very few did. It ranked 21st out of 22 of the surveyed risks. However, when we asked the respondents if they expect AGI to be meaningfully achieved by 2030, 44% of all respondents said yes, and this includes 50% of industry and 51% of AI vendors. So, as I bring this presentation to a close, I'd like to invite you all to get involved in two impactful initiatives. Firstly, this July, we are launching the CDIR Agentic Regulator Hackathon, and this initiative aims to bring together 100 public authorities from around the world in collaboration with AI vendors, the financial industry, AI researchers, and engineers to collaboratively build agentic AI prototypes to directly enhance policy, regulation, enforcement, and collaboration. Participants will be building prototypes to tackle our most pressing regulatory challenges around fraud, financial advice, agentic payments, horizon scanning, and much more. Please have a look at the QR code on the left here shown. And then secondly, I wanted to give you a bit of an outline of our upcoming 5-week AI in FS for Public Authorities program, which is launching in June. And this program equips regulators, supervisors, and policymakers with practical frameworks to understand industry AI adoption, the evolving global and regulatory policy landscape, and how financial authorities are able to use AI within their own workflows. So please do have a look at the QR codes shown to find out more details. And with that, thank you very much for your attention. I'll hand over to Brian.
Thank you very much, Kieran, for the presentation, and great to see that we have over 700 people in the virtual room and rising. We now proceed with our panel discussion in collaboration with the CDIR. The panel will be chaired by Augustine Costens, who is the CDIR co-convener and former general manager of the Bank for International Settlements. He's joined by Drew Propson, head of technology and innovation in financial services at the World Economic Forum, John Frost, head of innovation and the digital economy at the BIS, Harish Natarajan, practice manager, financial inclusion and infrastructure of the World Bank Group, Gillian Tate, provost of King's College, Cambridge, member of the Financial Times editorial board and the CDIR co-convener, and Michael Vassi, chief data officer at the Central Bank of the UAE. Many thanks to our esteemed panelists. Please switch on your camera. And thank you very much, Augustine, for joining us very early in your morning. It is over to you. Thank you.
Well, thank you very much, Ryan, for the kind introduction and invitation. And thank you, Kieran, for presenting the amazing results that produced the study. Needless to say, it is a real honor to be part of the launch of this great report. This global study is a very important contribution, and it comes at a highly consequential moment. Developments in recent weeks, namely the release of ever more capable models tailored to specific use cases, including the identification of cyber vulnerabilities, have sharpened the sense of urgency around AI governance. We knew AI was moving fast, and we know the potential benefits that AI can bring, including efficiency gains, hyper-personalized services and products, as well as financial inclusion. But we also now see more clearly how it can also break things without guardrails, including things that matter deeply for financial stability, economic resilience, consumer protection, and public trust. The reaction from governments and public authorities in the US, the UK, and elsewhere in light of the recent event shows that regulators are alert and that questions of cybersecurity, accountability, and public sector preparedness are moving more firmly into focus. This is the context in which the study and today's discussion should be understood. By bringing together perspectives of financial institutions, AI vendors, and regulators, the study captures a changing landscape in which incentives, risks, and responsibilities are intertwined. All three perspectives are important to inform our discussion today. We will focus our panel discussion in three interrelated sections. First, how AI is changing financial markets, including products, processes, and structures. Second, what does this imply for risk, especially around privacy, cyber concentration, explainability, and how to preserve accountability? And third, how can public authorities respond through policy and institutional reform and making use of the technology themselves? So let's go straight to our panel discussion. We need to cover a lot of ground in just 40 minutes, so I remind our stellar panelists that brevity but conciseness is of the essence. So a first round of questions or a first round of interventions, more than anything, ask from the panelists, having you heard the findings of the report, the question is, what is your main takeaway from the report that you would like to highlight? And just express this in 1 minute. Just your initial reaction, your response from the gut about this very rich report. So let's start with Gillian, please.
Well, thank you very much indeed. And let me join you, Augustin, by congratulating the authors and saying this is indeed a really pioneering report on a crucially important topic that we all ought to pay attention to. Key points from me are one, the disparity between regulators' use of AI and the private sector's use of AI, and that creates an imbalance that could leave regulators on the back foot. Two, the extreme concentration in the financial industry on just a few service providers, which sit outside the regulatory perimeter of central banks and regulators today, but are critical to the system and could potentially pose real problems if something goes wrong. Augustin has talked about that quite a lot. And three is the sheer speed of adoption that's occurring right now, which again creates huge challenges, not just for financial companies, but for regulators above all else, as well as investors trying to make sense of what is or is not safe.
Excellent. Thank you very much, Gillian. Now let me give the floor to Harish, please.
Thank you, Augustine. Like you said, I think bringing together the three different perspectives is very helpful. So I will also go with the point about the gap between regulators and industry, as Gillian mentioned. That is very, very striking and, of course, has a lot of implications. The second highlight for me was about the distinct kind of the differences in the views related to measuring outcomes versus the level of adoption. And here in particular, I think the point about focus being on the back office versus business transformation perhaps is an explanation why it is difficult to measure the outcomes, but it is kind of resonating with the general discussion in the industry overall about the impact of AI. The third area for me was about while there is consensus of the risks, there are differences, of course, in the perception and materiality of this risk, notably in areas related to concentration risk, as Gillian was mentioning, also operational risk and cyber, and then also this point, implications about the loss of human oversight. And lastly, I think this divergence in expectation of explainability has important implications for adoption by regulators, and that was the other highlight for me. Thank you, Augustine.
Thank you very much, Harish. Now let me go to Drew, please.
Yeah, thanks. I would, of course, echo everything that's been shared already. And maybe if I just add one big takeaway for me from the report is just that the three pain points for scaling were the same for really all of the ecosystem actors that were surveyed. And so data quality, as Kieran mentioned, talent and legacy infrastructure. And while we'll definitely probably see some competition in these areas, I think it really points to an area of opportunity for collaboration. So once we know the key challenges and that these are shared, hopefully we'll come up with some shared solutions as well.
Thank you very much. Michael, please.
Good afternoon. Thanks, Augustine. Yeah, one big takeaway for me, I think, here is that AI, it's moved to widespread adoption now, which is great, but business strategy hasn't kept up with that. The report today, we saw the numbers just now from Kieran, 81% of firms use AI, but only 14% of them saw it as truly transformational to their strategy. So there is a risk, as I see it, that we deploy these powerful tools, but a lot of them are really about use in back office or automation or assistant type use cases. And then the benefits just aren't as large as we'd hoped for, as large as we perhaps promised to our senior leadership. So, if we want to really get the most out of AI, institutions need to rethink their whole model, top down. Do they even need all the same departments or business functions that they have now? What can they do that they never could do before? And the report, I think, shows that strategy level, kind of operating model level thinking, that change isn't happening widely yet.
Excellent. Now, last but not least, John, please, the floor is yours.
So let me start by thanking the team in Cambridge, and it's great to see the report coming out. We hope, of course, that it'll be something that will be very impactful for the outside world. And let me say that during this session, everything I'll be saying reflects my own views, not necessarily those of BIS. So the most striking feature for me, like what Gillian and Harish said, was about the disconnect between regulators and the industry. I noticed in particular, the view on risks. So 80% of regulators flagging data privacy and protection risks, and 59% flagging cyber and operational risk as key concerns. So of course it makes sense as regulators were paid to worry, but I would hope the industry is considering these risks as well, and that there's sufficient understanding of how to mitigate them.
Excellent. Well, thank you very much, all of you. I share also, as probably my top concern is this gap between regulators and industry. And let me just provide you a dimension that for me is very striking. You'll see how much resources are being invested by vendors and the industry, financial industry, in AI, all the different facets of AI, and then compare how much public money is being invested in increasing their capacity to handle the challenges of AI. The gap is huge. So I think this is a public policy issue, and not only limited to financial sector, but in general, if the government doesn't increase its capacity, doesn't invest in how will it perform now that AI is far more broadly and rapidly developed and used, there will be an ever increasing gap. And from a public policy point of view, at least from my point of view, that's a real concern. So now I will ask very precise questions to our panelists, and they will have now a little bit more time to develop their answer. 4 minutes, that's our expectation. So let me start with Drew. Drew, we have heard that firms are using AI mostly in internal functions. What will it take for the operational focus to evolve into a more fundamental reshaping of products and business models?
Thank you. I will just maybe echo the stat around this that Kieran had shared earlier, which is that 4 of the top 5 financial services AI use cases are for back office functions. And firstly, that makes a lot of sense that is the case. Certainly rolling out these back office functions and applications is less risky. If you fail, you're not going to fail publicly and spectacularly. It's also very easy to measure your return on your investment for the most part with some of these applications. And then also there's just so much streamlining on the operations side that one can still do. So it makes good sense. I don't think we want to take away from that by any means. However, if we do want AI to reach its full potential in financial services and ultimately have benefits for the end consumer, we do need to see a bit more happening on the front office side of things, or just reshaping of the products and the business models. So how do we get there? I would say it's 2 kind of key factors. The first piece is we do need to have greater regulatory clarity. You certainly don't want to put something in place, roll it out, and then have to roll it back again. Very costly, and it's not very efficient. And then the second piece is maybe multi-pronged, but this would be confidence. Here you want to have confidence in the technology itself. You really want to have confidence that you can roll out or deploy the technology without a major incident. And then you want to make sure that you're doing so profitably. This is where it's going to get a little bit more tricky, but I would say there's good news on all fronts in that we are seeing all of these being worked on. So we see regulatory environment. If we're looking across all jurisdictions, we know it's very front of mind for regulators, policymakers. A lot is being done there. There are changes on a daily basis. Same thing with tech improvements. We're seeing new announcements on a daily basis there. So we know that these tech improvements are there and continuing to evolve. And then I would say too, on the ROI, we did see some great stats with this data, with this report too, that demonstrate that we are seeing profitability from the application of AI. And I think it's very much a work that is heavily in progress. The key point here that is a little bit of a question mark would be the competence piece. And can we roll this out and deploy it without a major incident? That's where I think that talent conversation and the dearth of talent is going to come in, and institutions are going to have to really think heavily and clearly about how they do that. But for the most part, good news here. And I think we're definitely moving in a direction where the front office will be an area for deployment further.
Excellent. Harish, let me give you now the floor. The survey shows that nearly half of regulators view AI as potentially supporting financial inclusion. What factors, in your view, will determine whether AI narrows exclusion or widens it?
Thank you, Augustine. I'm actually surprised that it was only 50%. I would have expected a bit more. But perhaps it is to do with kind of more focus at the back office rather than on the front office side, as Gillian was mentioning, and also the business transformation. I think it'll be useful to understand a little bit first about the pathways through which AI could impact financial inclusion, and then that, I think, will lead us directly to the constraints. I think, in general, I think lowering the cost of provision of financial services, kind of AI can help in that very significantly. There's a lot of discussion about the back office, but also in the front office currently with respect to customer service. Some people will categorize that as back office, but I think it is a front office function. I think lowering the cost of monitoring quality of a loan, all of that, I think AI can really lower the cost of provision, and that, of course, has an impact on financial inclusion. And also importantly, use of AI for underwriting, both for credit and insurance and other products, I think could be quite transformational. This is an area where traditional machine learning has been applied for a long time, but with new sources of data, I think that there is more possibilities which could be unlocked. And then also from a consumer side, I think the lowering the cost of discovery of financial services, and then perhaps one can imagine with the use of agentic AI, how they could interact with it could change. So there could be an implication because of lowering the cost of using financial services. And then more generally, if it improves supervision, then it improves the trust in the financial sector, and then also more ability to enforce regulations. So that could also have a positive implication for financial inclusion. And then lastly, I think AI is, of course, one of the new areas, but there are a lot of other innovations. So there is a compounding effect of different innovations, and that could, of course, lead to further inclusion gains. In terms of the constraints, kind of directly leading from that, I think there's a bit of path dependence here. I think there were some initial indications in the survey that more investment leads more outcome and leads to better returns. And also to unlock the benefits of agentic AI and other further developments, I think one needs to have a very solid technology stack to begin with. I think that will have an impact on the financial inclusion outcomes. Data architecture and governance, I think, is going to become a very important point. But of course, not all AI is created equal. So Gen AI, maybe you could handle without much of internal data architecture, perhaps. But I think if you really want to look at all the other gains, focus on the internal data architecture and governance becomes important. And I think the implications of competition is very, very important here. There's a possibility of winner takes all kind of a scenario that typically doesn't lead to good financial inclusion outcomes in the long run. So here, I think creating a level playing field through initiatives like Open Finance and other digital public infrastructure initiatives would also be, I think, important to ensure sustained financial inclusion gains. And then lastly, there was a lot of concerns related to risk related to bias and data protection and privacy. Unless we get a handle on that collectively, I think the financial inclusion gains would be difficult to achieve. So here, I think the role of regulation, role of responsible innovation, and then also the product designs will become very important. So with that, let me pass it back, Augustine.
Thank you very much, Harish. Now let me move to Michael. As more agentic systems are introduced, how do you assess and manage the financial stability risks they may create, including herding and collusive behavior?
Okay, so when we talk about agentic systems, I think what worries me more from a financial stability perspective, it's not really about one clever model in one institution. It's about what happens when many institutions, often using very similar foundation models, similar data, similar cloud providers, they all start to delegate decisions to those systems. That's where you can get herding, like pro-cyclical behavior. In the extreme, you can get outcomes that actually look a lot like collusion, even if nobody's actually sat in a room and agreed to do anything wrong. We assess the risk of that on different levels. So we look at market behavior and pro-cyclicality. The IMF was clear in their report around herding being a top concern. If agentic systems are all trained on the same data and they're tuned to respond to the same signals, they do tend to move together, especially under stress. In equity markets, for example, in the US, we see that over 70% of trading volume now is algorithmic. If you add to that things like autonomous portfolio rebalancing, trading agents, and so on, the risk is that during a shock, they all do the same thing. They all run for the exit at the same time or move to the same safe assets at the same time. And that can amplify fire sales and liquidity squeezes and so on. Here in the UAE, we're not quite the same volumes of algo trading, but we are taking measures. So our starting point is we don't assume that a diversity of models automatically gives us diversity of behavior. So in our macro-financial surveillance, when we run our stress test scenarios, we ask, if many institutions' agents hit the same thresholds at the same time, what does that do to market functioning and funding conditions? So that's a change in mindset, so away from looking at individual model risk to thinking about synchronized model behavior. Secondly, we look at concentration and the AI supply chain. So the FSB's framework, the 6 vulnerability framework, is quite blunt on that. 3 cloud providers provide more than 60% of global capacity, and a very small set dominate the foundation models. So for us, that concentration's a risk. That really is a big risk. So that set of same models can create correlated risks, and we reduce that concentration through things like use of our own sovereign financial cloud. So our approach here in the UAE is to preemptively limit where full autonomy is allowed under our CB UAE guidance. For high stakes decisions such as credit approvals and insurance underwriting and fraud, we require human in the loop. So no fully autonomous decisions in those areas. For the more agentic use cases, we ask firms to implement guardrails, so clear constraints on what the agent's allowed to do, documentation of the objectives, robust testing under stress and so on, same as we do for non-AI models. And on top of that, we have started to monitor at the system level. So not just firm by firm. So we collect data on where agents are employed, which business lines, which providers, and we look for unusually correlated behaviors across those. So that's where we want to use AI more on the supervisory side as well, looking for anomaly detection, early warning indicators, pattern analysis, that picks up too much similarity in decisions. So basically, none of that's to say we're anti-automation or anti-AI, not at all. In fact, CB is investing heavily in AI ourselves, new enterprise data management and lakes and early warning systems. But basically, we don't see agentic AI as a separate set of risks. We see it more of an amplifier of traditional familiar vulnerabilities like concentration and pro-cyclicality. So we make the boards accountable for where they deploy the systems, and we upgrade our own supervisory toolkit so we can see those herding outcomes. And if necessary, then we can lean against them in time before they become a threat to financial stability.
Excellent. Thank you very much, Michael. Let me now move to John. John, should regulators see the concentration of the AI supply chain primarily as a competition issue, a resiliency issue, or a strategic dependency issue?
So I think it is all 3 of those things. Of course, we've talked about this already a few times now, this very high level of concentration in various layers of the AI supply chain. And of course, researchers have shown that this is apparent in the market around the world. There's a box in the report by Vatsala Shriti, Kumar Rishab, and myself on AI supply and value chains, and showing that the AI supply chain is really dominated by this handful of global AI giants, across 5 different layers that we distinguish in the supply chain. And look, I mean, these giants have gotten there through remarkable breakthroughs in many cases. They have the necessary scale and talent to operate at the technological frontier. Of course, there's good reason why industry and regulators rely on these providers. They are, in many cases, very good at what they do. But this is a market with significant network effects and winner-take-all dynamics. And of course, mergers and acquisitions are certainly part of the story as well. AI giants are also becoming dominant players in M&A deals, often acquiring new and promising startups and firms that otherwise might challenge them. So throughout the report, I mean, there's a reference to regulators, which of course is the category of interest, and high level of aggregation is important in the context of this report, also to protect anonymity of individual respondents. But in practice, we do have to distinguish between different types of public sector authorities. So I'm going to distinguish between three in particular. For central banks and financial regulators, which I'll put together, systemic stability and thus resilience, as Agustin was saying, is generally the key consideration. If any one large provider were to go down, if there were to be an outage, if there were to be a cyber attack against a systemic provider, then that is a big issue that could affect the entire financial system simultaneously. What Michael was discussing just now, I mean, the risks of correlation or herding behavior, that's, I think, a related issue that even if there is more diversity in the sector, could well be relevant for central banks and for financial regulators. But let's move then to the second set of authorities. When we talked about competition authorities, which in most jurisdictions are a separate government agency, it's naturally fair competition that we're most interested in, most worried about. And there, I think the issues that I mentioned, also around M&A activity, the potential for killer acquisitions and all of this, that's an issue that competition authorities are thinking about quite a bit, and whether the technological parameters, whether the interoperability, all of these things are allowing for fair competition between different providers. And then there's the third set of authorities, and I'll just talk about governments and the administrations generally. There, I think strategic independence is key. I think it's clear to all of us that we're in a world where geopolitical considerations matter a lot, where there are certainly scenarios in which dependence on foreign providers is seen with some concern by authorities. That's generally the realm of the government rather than the central bank or the competition authority. But yeah, I think that for them, then these issues are important. So all three aspects matter, but each type of public sector authority will look at it from the perspective of its own mandate. And of course, then they'll have a different perspective on the necessary measures to try to address these risks as well.
Excellent. Thank you very much, John. Now let me finish this round of questions with Gillian. Gillian, the report points to a clear explainability gap and to unresolved questions around accountability. As AI becomes more autonomous, what governance mechanisms will be needed to sustain trust?
Sorry, there is indeed a profound problem around communication and understanding right now. And I say that as someone who spent many years of my life in the communications business, which is finance is always confusing and complex to not just the wider public, but the politicians. Just look at what happened with subprime mortgages and CDOs and CDS and all the rest of it a few years ago. Where essentially you had a tiny group of geeks or technocratic geeks with enormous power in their hands, which were widely ignored by everyone else, and no one else knew what they were doing. So we now have this problem on steroids with AI, because we're not only dealing with complex finance, but technological issues that almost nobody understands. And one big problem is that the regulators themselves have historically been divided between those who look at money and those who look at telecoms or digital issues. They are only now beginning to be brought together, and this whole initiative is part of that attempt to try and bridge that gap. So there's an enormous problem here around governance. There's the immediate problem, which is that I don't think most of the CEOs at the big banks and financial institutions have the foggiest idea how these agentic AI systems actually operate. I'd love to think I'm wrong, but I suspect I'm not. Secondly, I don't think the regulators have much chance of really peering inside these systems either at the moment, given the imbalance in expertise and focus that this survey has highlighted, and also the speed at which the industry is moving. And thirdly, I think the wider public and political class are completely, baffled by what on earth all this means. There is a media history in the Judeo-Christian traditions in the West, which means that most people are intrinsically scared of AI because they first found about it through watching things like Terminator or 2001 Odyssey. Very different from a culture like Japan, which I know well and lived in for years, where most people first learned about AI and robots through cuddly figures like Astro Boy. And partly because of that, there's a very different perception of how AI interacts with humans in Japan, partly because of the Shinto religion, from the Judeo-Christian cultures in the West. But the point is this: many ordinary consumers and politicians are scared. We've seen a backlash in the US. It's now swelling quite dramatically against AI. Events like the decision by Scott Bessent to pull in the big bank leaders to talk about mythos and the anthropic models recently is very welcome because it shows that regulators are acting, but it also shows that we're just at the beginning of what could potentially be a very big communication and understanding gap that could create potential financial stability problems, create a wider distrust of finance going forward, and create a bigger backlash in the future. And it's worth remembering that the roots of the word credit come from the Latin credere, meaning to believe. As an anthropologist, I would argue that finance without faith is worth precisely naught. And both the techies and bankers need to remember that.
Excellent. Thank you very much for this very exciting thoughts, Gillian. I share them fully. And thank you all for the panelists for their opinion. Now we will go to a second round of interventions. It's expected for you to give now a little bit shorter answers. We don't have much time to go, so let's get going. Michael, let me start with you. The report suggests that regulators are still behind industry in their own adoption of AI. Where do you see the most promising uses of AI in supervision today? And what is still holding supervisors back?
Okay, well, I think firstly, as a regulator, there's a big opportunity in risk-based supervision and early warning. We are moving away from a world where supervisors look at regulatory return spreadsheets, banking return forms on a kind of monthly, quarterly basis, to a world where we can ingest very large volumes of granular, near real-time data and use that to ask much more targeted questions. In our case, we use AI embedded in our SupTech program, so that underpins all our risk-based supervision framework. We use AI in advanced analytics for things like picking up anomalies in regulatory filings, building licensing analytics, supervision analytics. We can see patterns across applications, across breaches, and so on. And also for things like risk-based scoring tools. So we help supervisors prioritize which institutions, which banks, insurance companies, and so on need deeper intrusive work or on-site inspections. And we also use AI quite widely as a regulator in things like credit quality, stress testing, looking at the business models of banks, network analysis, even countering fraud. So AI really is helping us to focus our supervisory resources on the highest risk areas, which is really what risk-based supervision is about. The second thing is that AI, of course, is very powerful in dealing with unstructured data, and supervisors sit on very large volumes of unstructured data, documents that are rich in signals, but really impossible for anyone to digest end to end over large volumes. So we're deploying Gen AI there to help with a load of use cases. So things like reading large volumes of minutes and policies and inspection reports, so we can highlight issues relevant for governance or culture. Also things like assistance, where we feed parts of our rulebook and policies into RAG systems, so supervisors can ask questions in natural language. And third, I'd say there's a kind of more promising line of work, which is more emergent, which is what I call AI-enhanced financial stability surveillance. And we're building tools around that, so stress testing and scenario analysis, where AI helps us to explore a much wider range of scenarios, including like fast feedback loops. And also using AI to support new technologies or the simulation of new infrastructures like retail CDBC, where we just don't have the existing volumes of data. We can use AI to simulate that and look at the potential impact on liquidity and stability. Briefly, just in terms of what's holding us back as regulators, I'd say two very practical issues. First is data foundations. All AI needs good data. And many authorities, and we're partly through this ourselves, many authorities are still modernizing their landscape, cleaning historical data, building data lakes, and so on. It's not always glamorous, but it's essential. Data governance, data quality, catalogs, data models, it all makes AI and SupTech possible. The other one I'd call out is something which many of us struggle with is just availability of vendors who really understand supervision. We found it quite difficult to find deep SMEs to partner up with our analysts and our programmers to do proper business case analysis and supervision. So to summarize, for me, the constraints, it's less about technology, although that is a challenge, but more about the data foundation, the skills, and finding the right partners. And I think if you can get those right and invest in those early, you can move quite quickly on the use cases themselves, which is what we're starting to see now.
Thank you very much, Michael. Harish, following up on the question I made to Michael, from your point of view, what are the main hurdles to adoption of AI by public authorities in emerging and developing economies? I know the World Bank covers all these regions extremely well, so I'm sure you have a very good view about this aspect. Please.
Thank you, Augustine. We actually did a recent survey for the G20 in South Africa. So I'll base my remarks on some specific findings from there, which in fact complement very well the findings of this study. Augustine, and as all the panelists and audience knows, emerging markets and developing economies is a very very diverse cohort. Some of the countries in them are pretty far advanced in adoption of AI. So I will talk more. Whatever I say applies more to those countries which are not which are in the early stages of AI adoption, if I may put it that way. And the challenges they face, the survey highlighted some, and that is consistent with what we find in our study. And I think Michael also raised them. In terms of the highest barrier really is about the internal data architecture and governance, as I was mentioning earlier. Now, supervisors rely on a lot of data. Some of it is public. As regards public data, of course, you can use Gen AI tools and you are able to overcome that. But regulators also base their actions on a lot of proprietary data, reporting by the institutions, their own observations, and so on. And if those are not organized properly, then you are hampered in your application of AI tools. So I think that is the biggest constraint we have noticed. There is also, of course, a skills issue here. There are, of course, some staff in the regulatory agencies who are very familiar, others are not. And how to help improve the skills, I think, is a big challenge currently. And in that regard, I was very pleased to see the announcement of the CCAF course. So I think really some pedagogical innovation is required here to level the playing field in a way for regulators, because it's not about really understanding the intricacies of all the AI models. This is a different level of understanding, right? So it's about understanding what it could do, what it cannot do, what are the risks, and so on, which can be taught and people can learn those, but it has to be done in a very different way. And I think that is the second issue. In some of the emerging markets and developing economies, there are legal constraints related to the use of cloud and also requiring that the data be localized. And here it becomes very critical of how they could handle that situation when a lot of the proprietary data is subject to the data localization constraints. And similarly, the use of cloud, and I think as the survey pointed out, there's a heavy concentration of particular providers, and they might not be able to use them. And then lastly, there's a general mindset and fear about the data privacy and security risks. And then, of course, here, one also needs to recognize that whether you use it or not, you're still exposed because of all the different developments. So I think here the mindset point, I think, should not be underestimated. And that is the fourth one. And with that, let me stop, Augustine, and I'll pass it back to you.
Thank you very much. Gillian, in my opening remarks, I referred to the response of governments in the US and the UK to the cyber risks posed by the latest models. Do you see this as a turning point for AI policy?
I think it's a turning point in terms of public and political awareness. I think it's also raising a very important issue, which is that our vision of finance and tech, until quite recently, was shaped by a globalist vision that assumed we were knitting together the markets around the world in a fairly seamless, integrated way. Today, we're in a world of vicious geoeconomics and geofinance, where countries like America are battling for their own sovereign interests and sort of national economic strategies. So the question about how that is going to dovetail with all this is going to be critical going forward. We've just heard Michael talk about the desire to have sovereign control over their cloud within the UAE. Entirely understandable. Europe, I'm sure, will go down that route. So this is going to create another big challenge as we go forward, which I think has barely begun to be discussed. And apologies, I'm going to have to drop off now, but I would once again commend this incredible initiative and report.
Thank you so much, Gillian. Now let me move to Drew. Drew, what role do you see for public-private cooperation in managing these risks and closing the capability gaps between innovators and regulators?
Yeah, thank you. I'll do my best to keep it brief here. Just, I think first and foremost, we heard a little bit about divisions, a lot of fragmentation that we're seeing, but we know that we have a very interconnected financial system. So we need to have all parties involved in order to have the successful integration of AI, which includes managing risks. So I think we keep that as our North Star and we think about certain areas we can come together. We'll hopefully start moving in a more positive direction. First and foremost, what we really need to have is just better knowledge exchange, sharing of lessons learned. Here at the Forum, we are the platform for public-private cooperation. This is something we actively do on a regular basis. Certainly events like this one here as well is a great opportunity to bring together private sector, public sector, learn from each other, and continue the conversation with some good data standing behind it. Very specifically, what we can see in terms of knowledge exchange that is helpful. Office hours, we see a lot of regulators holding office hours where they can get those industry perspectives. This is important, and we're seeing it be contagious, and a lot of jurisdictions are doing this. Sandboxes, of course, can be very effective depending upon how they're constructed. So having the opportunity for private sector firms to be able to test new solutions in contained and controlled environments. Roundtables, as I mentioned, such as this one, important. Sometimes it's nice to have closed-door Chatham House rule conversations as well with private sector, public sector to really get some of the failures out in the open as well without the fear of media being there and having it be a very public failure. And then lastly, I'll just say shared resources. We have heard, of course, that maybe some of the regulators and financial authorities are falling behind on certain areas. This makes perfect sense. They have less resources. So how do we collectively come together to be offering resources for those who might have a little bit less? At the Forum, we have a secondments program, for example, where we do take private sector talent for short-term virtual secondment assignments where they can help with one type of digital implementation, often using AI for greater supervisory technology and implementation of soup tech. So these types of activities we are seeing expand, which is great. And I just want to really emphasize that I think in terms of collaboration, what we need going forward is continued knowledge exchange and continued feedback loops that hopefully will get us to a positive and responsible place for the deployment of AI. Thank you.
Thank you very much. Now, John, you get the final word. AI-related risks do not fit neatly within existing regulatory and jurisdictional silos. They cut across mandates and across borders. What new forms of institutional innovation and cooperation do regulators need to harness and explore?
Very good. So, as I mentioned earlier, AI-related risks in financial services affect central banks, financial regulators, competition authorities, other government bodies, cybersecurity agencies, etc. And then there's the private sector, the incumbents, new entrants, vendors, etc., as Drew was just discussing, and all of that in different jurisdictions around the world in a time where geoeconomics are becoming more important. So that does seem daunting, but luckily the international community does have experience in bringing authorities from different countries together and having a structured dialogue among peers and with the private sector. So I just mentioned the experience of the Financial Stability Board, or FSB, which gathers central banks, regulators, ministries of finance, and international organizations together with a mandate to promote global financial stability. And the FSB has actually been looking at AI in financial services for many years now, including in discussions with the private sector. There are other groups. I mean, certainly a number of private sector bodies where authorities can come together, including under Chatham House rules, including in safe spaces. So there are certainly institutional structures to build from. I think it's just a matter of using them effectively and sometimes in creative ways in order to address the risks.
Excellent. Well, thank you very much. We're almost on time. So let me get back to you. And thank you all the panelists for extremely valuable points of view.
Thank you very much, Augustine, and very grateful to the panel for sharing their perspectives and insights. Thank you very much. And that brings us to the publication of the 2026 Global AI in Financial Services report. You can now download the report by scanning the QR code on your screen or follow the link that will be provided to you by our team in chat. We hope that you will find the report useful and interesting. Please do take the time to answer our quick poll. Thank you very much for joining us today, and we're looking forward to seeing you at the future CCAF and FI events and the CDIR Policy Convening Series. Have a great rest of the day wherever you are. Thank you very much indeed. Thank you.